Howdy, folks. Welcome to the Liberty Call. It is Thursday, August 18th, 2022. Sorry, I'm a little distracted. The Astros are playing. They're up 10-3, top of the sixth, one out. Altuve just got robbed of a home run, which a little sad, but Yuli just hit another single, so that's good news. If it's your first time watching, please give me a like, share, subscribe. Lots of those big old thumbs up. I really appreciate it. And pretty good day in the markets. The Dow was pretty much the laggard. It looks like it did finally get into the green and stay there at closing time. And kind of the opposite of yesterday. The Asian markets look terrible today. They were really good yesterday, and kind of the opposite for our markets yesterday were down, and so vice versa. Anyways. All right. Well, like I said, hope everybody's having a good day out there. Gonna go through the market indexes, cover today's market recap, go over the labor numbers that came out today, and I'm seeing a lot of articles either way about is this the bottom or was that the bottom of the market in June? Are we now on a rally? Is this a bear market rally and we're headed for more downtimes? I don't know. I wish I had an answer. I mean, my charts are starting to improve and look like things are turning around, but knowing of all the other collateral damage we have in the economy, again, it's really tough to tell. All right, well, let's go ahead and jump in and see how the numbers were today. The Dow Jones basically flat. It was up 0.06%, closed at 33,999. The S&P 500 was up 0.23, closed at 42.83. NASDAQ up 0.21, closed at 12,965. Small caps are up 0.71. The VIX pulled back today, 1.71%. It's currently at 1956. Still very close to that 20 number, which is where we start to have some caution with the equity markets. Moving over to Canada, they were up 0.42%. Brazil was up 0.09. Mexico was flat at down 0.01. Jumping across the pond, Germany was up 0.52, UK up 0.35, France up 0.45, the Euro stocks up 0.56, Netherlands up 0.38, Spain slightly down 0.05%, Italy up 1%, Switzerland up 0.35, and Portugal basically flat at up 0.01%. Headed over to Russia, the MOEX was up 0.26. The RTSI was up 2.28% today. And moving down to the Asian markets, like I said earlier, they were all down. Japan was down 0.96. Australia down 0.21. New Zealand down 1.17. Moved over to China. Ooh, is that a home run? Bregman just hit a 2-run home run. We're up 12-3 now. Woo, go Breggy. The Shanghai was down 0.46. The SCSE component down 0.62. The China A50 down 1.1%. The DJ Shanghai down 0.57, and the Hang Seng was down 0.8, and the Taiwan weighted came in down 0.44. So those are our major indexes across the globe today. So like I said, here domestically, things were pretty good. Same across Europe. Had a few blips here or there. And then, like I said, the Asian markets really took it in the shorts today. All right, well, let's go ahead and breeze through today's market recap. S&P 500 climbs as energy powers ahead. Chip stocks rebound. The S&P 500 climbed Thursday as chip stocks snapped their recent malaise to power tech, even as Federal Reserve officials talked up the idea of another large rate hike next month. Semiconductor stocks climbed more than 2%, led by a surge in Wolfspeed after the semiconductor products maker reported better than expected quarterly results and upbeat guidance on Semiconductor Corporation and Marvell Technology were among the biggest gainers in the chip sector. Energy stocks also played a big role in the broader market climb as oil prices continue to ride, easing fears of U.S. recession higher. Devon Energy, Halliburton, and APA Corporation were up sharply, with the latter up about 8%. Data on Thursday showed labor market remained robust and manufacturing activity rebounded. Initial jobless claims fell to 250,000 from 252,000 last week, below the consensus of 265,000. So again, a little bit better. The guess was 265. We came in at 250. still a little higher than I'd like. I mean, we were down below 200,000 for a couple of months earlier this year. And, with the number of help wanted signs that I see when I go out and about, when I do venture into civilization, I imagine there's lots of jobs out there. People just evidently don't want them. The Philly Fed Index rose to a reading of 6.2 from negative 12.3 in August, topping economists' forecasts of a negative 5, helping alleviate worries about a significant slowdown in manufacturing data earlier this week, showing a steep decline in activity in the New York area. Stronger economic data have some Federal Reserve members backing the idea of a larger rate hike next month as inflation remains elevated. Quote, we should continue to move expeditiously to a level of the policy rate that will put significant downward pressure on inflation, end quote, Federal Reserve Bank of St. Louis President James Bullard told the Wall Street Journal on Thursday. The comments come as investors continue to price in the prospect of a less hawkish 50 basis points at the September meeting, but Fed Chairman Jerome Powell is likely to push back against the idea of a Fed pivot to a less hawkish policy at Jackson Hole next week. Wow, Jackson Hole, that's pretty nice. It's out in my vicinity. Well, maybe not close by, but there's nothing close out here in the West. I mean, it takes forever to drive from one city to the next. Quote, the Feds won't be receptive to the easing of financial conditions that we've seen in the past 2 months, end quote. John Luke Tyner, portfolio manager at Aptus Capital Advisors, told investing.com in an interview on Thursday. Quote, the Fed will keep the pedal to the metal on rate hikes though the number of 75 basis point hikes that they can do consecutively is probably coming to an end, Tyner added. On the earnings front, Cisco Systems rolled out guidance that topped estimates after reporting quarterly results that beat estimates on both the top and bottom line, sending its shares more than 6% higher. Kohl's fell more than 6% after it cut its annual guidance as inflation continues to put the squeeze on consumers. The retailer now expects net sales to decline by 5 to 6%, down from a prior forecast for flat to up 1%. In meme stock related news, Bed Bath & Beyond, which has racked up more than 300% gains for the month, slumped 22% after activist investor Ryan Cohen looks to sell his stake in the company. So again, some good news, some bad news. The labor front looks still pretty good, but it does look like at retailers things are starting to slow down. So again, don't be shocked if things turn for the worse sooner than later. All righty. Next up, here's an article about the labor market. U.S. labor market resilient despite rate hikes. Housing market is wilting. The numbers of Americans filing new claims for unemployment benefits fell last week, and the prior period's data was revised sharply lower, suggesting labor market conditions remain tight despite a slowdown in momentum due to higher interest rates. The weekly unemployment claims from the Labor Department on Thursday, combined with strong industrial production in July and underlying retail sales growth, to allay fears that the economy was in recession. The claims report, the most timely data on economic health, could give the Federal Reserve more ammunition to deliver another hefty rate hike next month. Quote, fears of broad-based layoffs have yet to materialize, said Mahir Rashid, a U.S. economist at Oxford Economics in New York. Quote, still we doubt claims will accelerate sharply as labor demand remains well ahead of labor supply, while the outlook for the economy remains relatively positive despite elevated uncertainty regarding inflation and growth, end quote. Initial claims for state unemployment benefits slipped 2,000 to a seasonally adjusted 250,000 for the week ending August 13th. Data for the prior week was revised to show 10,000 fewer claims than previously reported. Economists polled by Reuters had forecast 265,000 applications for the latest week. A hefty revision and last week's modest decline pull claims well below the 270 to 300,000 range that economists say would signal a material slowdown in the labor market. Unadjusted claims fell 4536 to 191,834 last week. A surge in applications in Massachusetts was offset by notable declines in California, Ohio, Texas, and Georgia. Companies in the interest rate sensitive housing market and technology industries have been laying off workers in response to slowing demand caused by the Fed's aggressive monetary tightening campaign to tame inflation. But elsewhere, businesses are hungry for workers. There were 10.7 million job openings at the end of June, with 1.8 million openings for every unemployed worker. Strong demand for labor was underscored by a separate report from the Philadelphia Fed on Thursday showing a measure of employment at factories in the Mid-Atlantic region surged in August, and businesses are optimistic about the jobs market over the next 6 months. As a result, the Philadelphia Fed's manufacturing index rebounded to a reading of 6.2 this month from a negative 12.3 in July. A reading above zero indicates expansion in the region's manufacturing, which covers eastern Pennsylvania, southern New Jersey, and Delaware. The rebound was in stark contrast with the collapse in a gauge of factory activity in New York State reported by the New York Fed earlier this week. Stocks on Wall Street were trading higher, and the dollar gained versus a basket of currencies, and U.S. Treasuries rose. Next up, data next week on the number of people receiving benefits after an initial week of aid will shed more light on job growth prospects for August. The so-called continuing claims, a proxy for hiring, increased 7,000 to 1.437 million in the week ending August 6th. While the labor market remains resilient, the housing market is wilting. A fourth report from the National Association of Realtors showed existing home sales dropped 5.9% to a seasonally adjusted annual rate of 4.81 million units in July, the lowest level since May of 2020 during the COVID-19 lockdowns. Outside of the pandemic, sales were the slowest since November of 2015. July marked the sixth straight monthly decline, longest such stretch since 2013. The sales drop occurred across all four regions and followed on the heels of news this week that single-family home building hit a 2-year low in July. The median existing home price increased 10.8% from a year earlier to $403,800 in July. While that was the smallest gain in 2 years, prices typically retreat in July after surging in June. With fewer homes being built, prices could remain high even as demand softens, presenting a challenge for the Fed. Quote, "A meaningful price drop is unlikely," said Nicole Bashad, senior economist at Zillow. Quote, "Falling prices should bring demand back to the market and put pressure on prices to go right back up, especially as inventory is stabilizing at a much lower level than the pre-pandemic norm," end quote. So yeah, the housing market is definitely, I wouldn't say it's in real trouble, but it certainly is. Again, I think the interest rate environment is creating more slowing of the housing market, certainly than prices. Prices was pricing out a lot of people out of the market as they just exploded over the last 2.5 years. But at this point, if you could have qualified for a mortgage, say in February, for that, say, $300,000 house, well, now that interest rates have gone from 3.5 to 5.5. You probably only qualify for like a $225,000 or $250,000 mortgage, and so you've been priced out of that house, even if everything else just stayed the same. So, but there was something else here that jumped out at me. Where was it? It escapes me. I'll if I think of it, I'll bring it back up. All right, last article here. It's from some folks at Bank of America. Why the bear market hasn't yet bottomed, and this is from the Bank of America analysts. After the S&P 500 slid 23% from the start of the year through June 16th, the index has rebounded 17% off the bottom. It's not a 6% difference. It's much larger than that. This has many investors saying that the bear market is over and that the rally is here to stay. Not so fast, says Bank of America strategist. Quote, "Only 30% of our bull market signposts, things that happen before a market hits the bottom, have been triggered versus 80% in prior market bottoms," they wrote in a commentary. Quote, "That suggests another pullback is likely." The strategist said, "One signpost with a perfect track record since 1935 is the rule of 20. During that period, the sum of changes in the consumer price index from a year earlier, plus the market's trailing price earnings multiple, was always less than 20 at the market bottom. To bring that signpost current, in the 12 months through July, the CPI rose 8.5%, and the S&P 500's PE multiple recently stood at 21.6. That adds up to 30.1, well above that 20 threshold. Outside of inflation falling to zero, or the S&P 500 falling to 2,500 from 4,274 recently, on earnings surprise of 50% would be required to satisfy the rule of 20. So again, we'd have to have no inflation at all, and the S&P 500 would have to fall, 1,700 points? The strategist said, but the consensus forecast for earnings growth next year stands at 8%, and we think that's unachievable, the strategist said. Another Bank of America signpost on an enterprise value to sales basis, where sales should be elevated higher consumer prices, the market multiple is excessively elevated, plus 40% relative to history, end quote. The strategist said that's possibly because retail sales growth, excluding energy, is essentially flat. That would reduce the sales segment of the multiple. One point that isn't part of Bank of America's report, the biggest bearish factors for the market may be inflation and the Federal Reserve's interest rate hikes. Inflation could damp consumer spending, and the rate increases could weaken the economy, depressing corporate earnings. On the bullish side, the Fed has said that at some point it'll slow its rate increases, and the central bank may well shrink their size as soon as next month, meaning roaring inflation hasn't eliminated consumer spending growth. All right, so that was a short one, but again, don't get ahead of yourselves. I know a lot of people are looking at these charts and saying, all right, the worst is behind us. Everything's all good. But again, you want to be careful. So, all right, well, that's everything. Gosh, darn it. Now there's 3 men on base. This isn't good. It's bottom of the 6th. White Sox got 3 on base, no outs, and Maton is pitching. Boy, he's been doing rough lately. So if you don't watch Astros baseball, you may not be aware of that. All right. Well, that's everything I had for today. I hope everyone has a fantastical evening. If you need anything from me, please go to dsafinancialgroup.com. All my contact information is there. If you'd like to book a meeting, drop me an email or a phone call, please do. I love hearing from people. And hope everyone has a fantastic evening. I'll be back tomorrow with the weekly wrap-up. Have a good night. Bye-bye.